All right, so we just had Q1 earnings for Airbnb, and Wall Street has decided to sell this one off by 23%. Today, I want to dive deep into the results, and I'm going to tell you if Wall Street is sort of warranted in selling off the stock like this, or if they're focusing too much on the short term and ignoring the long-term picture. So this is the quarterly revenue on a 12-month adjusted basis, and notice that this includes next quarters on the analyst estimates. So as we can see, one of the main reasons why Wall Street is dumping this is because growth is sort of like balancing out, right? It's gone from 50% growth a couple quarters back to now for next quarter, they're expecting a 22% growth on a trailing 12-month basis. On a year-over-year basis, it's more like a 12 to 13% growth, maybe up to 15 or 16% growth. So this is the main reason why Wall Street is sort of dumping Airbnb left and right. And if we look at the actual earnings, we see a similar picture, right? Even though we've gone from very negative to very positive on a 12-month adjusted basis, we can see that the growth is sort of like adjusting and it's sort of like plateauing, right? And this is another reason why Wall Street is dumping. Essentially, growth all around is sort of stagnating, right, for Airbnb. But is it though? Let's find out. Let's look at the actual operating leverage, because this, as you know from previous videos, is one of the things that I care about. And we see that in here, the operating leverage is being sort of constant, right? It's not improving. And the reason for that is Brian Chesky said that they're actually spending a little bit more marketing in the early parts of the year to support the later summer season and Christmas season later on by the end of the year. So they're doing a lot more of the marketing beforehand and then sort of like tuning that down by the second half of the year. Now, another big reason why Wall Street is dumping this left and right is because if you notice here, they actually made 1.8 billion in revenues, right? But look at the expenses. They spent 1.8 billion dollars in just operating, cost of revenue, that kind of thing. So that leaves us with negative $5 million in earnings, right? And you know how it is, right? Stocks follow earnings. So the reason why the actual profit came at a 130 is because they made a ton of money from interest, but interests are not necessarily part of the core business. So Wall Street is punishing them for this, because even though you made 130 and then 117 after taxes, a lot of that, in fact 146 out of that, didn't come from the business. It came from interest that they had on their corporate cash and the money they had on behalf of hosts, right? So it's funny how they're getting punished for making money with high interest rates. All right, so I wanted to take a look at this graph right here, because this sort of paints a better picture. Let's zoom out real quick and let's see. So Wall Street was expecting Airbnb to maintain the 50% growth rate in all metrics in an environment where like interest rates have gone from 0 to 5.25% in 14 months. Does that make any sense? Obviously, the revenue is gonna plateau a little bit because it is like any business, right? In a tight environment, people just do not spend as much money as before. So the fact that they're doing a 20% growth even in this kind of environment is a testament to how good of a business Airbnb is. And expecting a 50% growth rate on a 5.25% interest rate environment is sort of delusional. And a very bright spot for the quarter was the free cash flow. Look at this, $1.6 billion on free cash flow. To give you an idea, Tesla, which is a company that we are all super familiar with, did $441 million in free cash flow last quarter. And this is not a knock on Tesla. We all know Tesla is one of the best companies in the world. This is just a testament to how much Airbnb is a cash flow machine. And on a trailing 12-month basis, they actually did $7.9 billion, which puts them at about 18 times market cap to free cash flow. This is so much cheaper than any of the tech companies that we're so accustomed to. Way cheaper than Apple, way cheaper than Tesla, way cheaper than Amazon, way cheaper than Meta. This is a cash flow machine, and they're actually buying back a lot of those shares with that money, which I like as a shareholder. But you might be wondering, how come they've made so much money on a cash flow basis if they're actually losing money on an operational base, at least for this quarter? Well, it's because they have a lot of unearned fees, right? This unearned fees. So if you rent a cabin in the wood for December, they cannot recognize this money until December, even though they already charged you for it. So that's why the actual cash comes before, and then they can sort of declare that as part of the revenue. Now, in terms of Wall Street, we have to wonder, are they seeing too much travel? Have you ever seen anybody who's like, you know what? I've traveled way too much. I don't want to travel anymore. Because as far as I know, everybody that I meet is like, yes, I would love to travel more. I would love to like go to the Greek islands, Europe, maybe Asia, maybe New York. Most people are underserved in this industry because the big thing for travel is expensive. It's expensive for most people. But if you ask the regular consumer, they would actually want to travel more, not less. It's just the price is a little bit too high in terms of stays and in terms of flights, right? These are the two biggest expenses for any traveler around the world to go anywhere. So Airbnb with the rooms is sort of taking care of the expenses, because when you drop a 168 average to a 50 or 60, that opens up the whole market to a whole bunch of new clients. So that's number one. So we have to wonder, are people gonna travel more in the future, or are they gonna travel less? If they're gonna travel more, which I believe is true, then where do you put your money? Because you have a couple of options, and these are the main options that we have thus far. The hotel chains, which if you compare on a gross margin basis to Airbnb, they are 3 times less. So Airbnb has 3 times the gross margins of a hotel chain, simply because it's a lot less infrastructure heavy, capex heavy. So that's why gross margins of Airbnb are 80 something percent. That's tech margins, you know, as tech as it gets. But also you have to consider the sort of booking sites like Booking and Expedia. Look at the revenue per employee when you compare these two, because these two actually match the actual gross margins, but in terms of efficiency of the business, they do not even come close. It's like a factor of 1.6x. So if you think in 5 to 10 years, people are gonna travel more, not less, because prices for transportation and prices for staying in the different places is gonna go down, then I would rather put my money on Airbnb as opposed to any of these competitors like Hilton, Marriott, Booking, or Expedia. But that's just me. I just think they're a lot more efficient. They have significant network effects, and they're just a lot more profitable. Wall Street is gonna sell the stock all the time, but that's, you know, a very short-term way of looking at it, because I think that in this sort of space, Airbnb is the biggest winner and will be the biggest winner for many years in the future. Another thing, I'm gonna finish with this. Airbnb is probably gonna be added to the S&P, because even though the dual sort of share thing is going against them, they're now profitable for 4 quarters in a row. I would be extremely surprised if Airbnb doesn't get added in Q3 this year, because Q3 is by far the strongest quarter for Airbnb. So I made a video about that. If you want to check it out, it's right here. And thank you very much for watching. See you next time.